Wall Street had 5 gains in a row last week, finishing the week 5.5% higher than the week before because of central bank action to boost liquidity in both Europe and the United States. But as Asian markets opened today, that sentiment had evaporated and all share markets traded around 1 to 2% lower. In Australia today, the fall was 1.6%, about the same as the China market. It means the All Ordinaries Index is down 10% for the September quarter so far, with less than a fortnight to go. Here are some of today's biggest moves. Westpac, Woodside and Qantas were down more than 2% each. Retailer Billabong was quoted ex-dividend. Cochlear recovered 5.5% of last week's losses. Now for us, the bear market began in November 2007, a couple of months after the credit crunch got underway. The point about this chart is to show that the Australian share market has been underperforming Wall Street since the start of 2010. That's when the Australian dollar began to really take off. But it wasn't just that. Australian companies have performed worse than American ones, and a clue to that can be found in the different unemployment rates. But it depends a bit on your starting point, doesn't it? The US bear market began in March 2000 and is now 11.5 years old. During that time, the S&P 500 has fallen 20% and the All Ordinaries has gone up 33%, thanks to that huge China boom between 2004 and 2007, when Rio and BHP both did 5 baggers, as they say, which means they went up 5 times. The gold price is on the move again, consolidating above $1,800 an ounce, and the Australian dollar is jumping around like a flea at the moment, up a cent one day, down a cent the next. And that's finance.